Okay, so thank you, Juri. It's been nice to follow the journey you described together, because I know you were also one of the first people to be interested in these methods before they were sort of really popular the way they are today. And thanks also to Michele for the invitation to give this talk, and for all of you for coming. So I should say, in the past when I've given keynote talks, I think it's nice to step outside a particular paper and maybe discuss a bit more general things. But the paper that I'm going to present today is so closely aligned with the themes of this conference that I thought I would just present a paper. Okay, so unlike Barbara's excellent talk yesterday, which covered a lot of ground, I'm going to discuss one paper. So I don't see the sort of conference subtitle, but I think it included various words like LLMs, risk, uncertainty, narratives. All of those things are basically what I'm going to talk about today. So hopefully it's relevant to your interest. I should also say that the version of this paper that's online is basically been totally revamped. So the content of these slides doesn't align with the circulating working paper. So in some sense, it's a completely new effort. So what's the central question? Well, for a long time, right, going back to this classic quote of Alan Greenspan, monetary policymakers have emphasized that they make choices under uncertainty constantly, and that's part of the decision-making landscape. And more recently, I think that these ideas have become even more influential as they become formalized into the strategic frameworks of large central banks. Right? So you probably know about this more than I do. But if you look at the ECB's most recent strategy statement, it's filled with this language about the governing council needing to take account of risks and uncertainty when they set monetary policy. The same is true at the Fed board. So the two working papers that are cited in this slide are also discussing risk and uncertainty as they pertain to monetary policy choices. Now, when you think about the academic literature, I would argue that there's been much less attention paid to this issue. So while policymakers are talking about it all the time, when you look at a standard macro model, there is not typically a role for uncertainty and risk in monetary policy decision making. I don't actually come from a macro background, even though increasingly I go to macro conferences and kind of even edit macro journals in some cases. But my understanding is in order to keep these models tractable, one needs linear rules. And once you start introducing higher order moments and those really mattering for policy, it sort of becomes complicated to work through the algebra of those models. Okay? I'm not sure if that's the case. It's just one hypothesis, but there is not a whole lot of academic work on this issue. Okay? So what we're trying to do here is first just ask an empirical question. All right? So first, how can I measure policymakers' perceptions of risk and uncertainty? Once I do that, I would like to quantify how those perceptions matter or don't matter for policy choices. All right? So we want to establish what we view as some of the first evidence that perceptions of risk and uncertainty really drive policy choices. All right? And then if that's the case, which I'll show you it is, I want to understand the mechanisms driving that relationship. So there may be many potential mechanisms. I want to highlight the difference between two. So one is what I'll call certainty equivalence, and another is what I'll call insurance. Okay, and I'll make those terms more clear as we proceed. All right, so what are we going to do? We're going to use the internal deliberations of the Federal Open Markets Committee, the same data set that Sophia discussed yesterday, or at least the same data set that Sophia was trying to simulate in her work yesterday, to measure these individual perceptions of risk and uncertainty. Then once I do that, I want to show that in a wide variety of policy regressions, including standard Romer and Romer type policy rules, but also panel regressions, that these individual perceptions of risk and uncertainty do influence policy choices, and the magnitudes can be quite large. Then I want to try to understand this insurance mechanism, and that's going to involve two steps. So one is to design an LLM query to try to measure the extent to which a particular policy choice is driven by insurance reasoning. And I want to show that this balance of risk channel has particularly large effects in meeting things where policymakers are trying to take insurance out against low probability but high cost events. All right, so I think that mechanism has also been discussed a lot in the policy literature, but I'm aware of no academic evidence establishing that it, that it operates and that it's quantitatively important. I've gathered over the last day there's a norm that people just listen to the speaker talk, but I'm used to a norm where people ask questions. So if anyone at any time, I don't know if the AV team will get upset with me for saying this, but if anyone wants to ask a question, I'm happy to answer. I mean, you don't have to wait for 45 minutes. All right, so just to set the scene a little bit, I want to clarify how we're thinking that risk and uncertainty might matter for policy decisions, right? So here is a standard loss function. It is quadratic and deviations of inflation from target and the output gap. And if you take the derivative of that to solve for optimal policy, you get this very simple marginal benefit equals marginal cost equation. And I guess the typical thing is to stick in a linear relationship between how expected inflation and expected output react to changes in the interest rate. And if you want to plug these linear expectations into the marginal cost equals marginal benefit condition, you get this linear policy rule, which I guess we're all familiar with. Okay? So, starting from this linear policy rule, how would you think about risk entering it and affecting policy choices? Well, this is an empirical paper, so I hesitate to call this a model. It's just a little framework to get us started before we jump into the empirics. All right, so what do we mean by risk management? So I guess one issue is it's not particularly well defined. So different academic papers have different definitions, but as motivation, we'll take this speech from Charlie Evans, in which he emphasizes that, one, the FOMC thinks about risk management considerations a lot. And when they do that, they basically engage in scenario analysis in a way that actuaries might in an insurance firm, right? Thinking through different scenarios and what might go wrong. So to capture this scenario thinking in a very simple way, we'll have this omega t state variable where omega t equals 1 is meant to capture the realization of an adverse event, okay, in some very broad sense. And that's a low probability outcome in the sense that the probability that this omega t equals 1, which we'll call pt, is less than a half. Okay? So that could represent a few things. It could represent an upside inflation risk. Okay? And if you want to model an upside inflation risk, you would say, all right, I'm going to take the standard expectation component from that linear relationship from the previous slide and just add a little bit of extra inflation to that, all right, if this adverse event is realized. In a similar fashion, you could view this adverse event as being to growth, in which case it would decrease expected growth by a certain amount. So I don't know if Leonardo Malosi is in the room. I was going to try to catch him after his discussion last night to make sure I wasn't misrepresenting his work. But given he's not here, I guess I'm not so nervous that I might be misrepresenting it. So you can feed this back to Leonardo, and he can email me if he doesn't agree. All right, so there's this paper by DePoulis and others, including Leonardo. It was published last year. I think it's actually cited in the ECB strategy review. And the idea is that risk management enters the policy function to the extent that it changes expected outcomes. All right, so if a tail risk emerges, it changes expected outcomes. Right? And because it changes expected outcomes, it's going to enter the policy rule that I just wrote down, but in a fundamental sense, it's really no different than where we started, okay? It's just a new term in the expectation. Okay, so there's a little bit of skew in, say, the right tail of the inflation distribution, but that only affects policy because that right skew raises expected inflation by some amount, all right? So I'm going to call that certainty equivalence because it's really just first moments entering the policy rule, okay? And risk management matters to the extent that the first moment matters. I believe that Manganelli is also at the ECB. At least I think he was at some point. I don't know if he is now, or if he's in the room. I have not met him, so my apologies if so. But if you want to deviate from certainty equivalence, it's not difficult to. Okay, so there's this Killian and Manganelli paper from 15 years ago, that says, look, I started with the quadratic loss function, and if I had started with the cubic loss function, for example, and taken the derivative of the cubic loss function, then there would be squared terms in the first order conditions, and when I take the expected values, now variance will matter, all right? So, certainty equivalence is going to be very fragile to this quadratic linear world. But what I'll say about this is that's all well and good, but in a fundamental sense, economic conditions are still exogenous to the policymaker's behavior. Okay, so I come into the meeting, the world is what it is, the distributions are what they are, and I react to those distributions. The insurance idea, which I want to emphasize at the end, takes a different view. It takes the view that the conditions that I face are endogenous to my choices. All right, and so if there is a tail risk in the inflation distribution, then I can insure against that tail risk by taking out, by choosing a more aggressive policy action. And in so doing, I will reduce the probability that that tail is realized. All right, so that's what I call insurance. The way that I'm going to introduce this into this simple model is to say the PT, the probability that this adverse event is realized, depends on RT. Right? And if you return to our simple marginal cost equals marginal benefit condition, you see that this term here, this P prime, is how insurance shows up. Okay, there's basically an additional motive to act against adverse shocks to the extent that you can endogenously remove them from the distribution. Okay, so let's keep that in mind and come back to that at the end. By the way, I was told I had 45 minutes, but when I started, this was on 50 minutes, so I guess I'm going to just talk until that's zero. Okay. All right, so the data set that we're going to use here is as I mentioned, the internal deliberations of the Federal Open Markets Committee. So Sophia discussed this data set a little bit yesterday, but let me review the basic structure. So these are publicly available from 1976 onwards on the FOMC website. There are verbatim attributed accounts of how policymakers debate in this particular institution. Especially in the early part of the sample, there are so-called conference calls that are convened outside regular FOMC meetings where policy choices are taken, which we will ignore. So our main sample, for reasons I'll discuss in a minute, goes from October 1982 to December 2019. All right, so there's a 5-year delay in the release of these transcripts, which is why it ends in 2019. I'll show you in a minute why we start in 1982. So this is a panel data set, so every measure I build is essentially going to be a panel, and there are 107 members in this panel data set. That's the number of unique FOMC members in this in these transcripts. Okay, so one initial question, I guess, is to what extent is risk management a modern idea? So to get, I guess, a very initial answer to that question, here are some time series, all right? So the top plot is the length of these transcripts starting from 1976 onwards. So transcripts get a little bit longer around the financial crisis, but before then, for 20, 25 years, the length of these policy deliberations stays relatively fixed. Right? The second and third panels are tabulating risk and uncertainty language in different ways, like balance of risk, risk around forecast, kind of looking for all these very basic words. And you see that these basically didn't exist before about 1981, 1982, all right? So it could be that policymakers were thinking about risk management before the early 80s and using a different language to what we use today. But because I'm not aware of what that language is, and I'm not sure an LLM is aware of what that language is, we're going to start our sample at this gray dash, where you start getting positive counts of words related to risk management, okay? Before that, the counts are basically 0 in 2/3 of meetings. So in building these empirical measures, I'm going to take advantage of the structure of deliberation. So the core part of FOMC meetings contains 2 different rounds. The first round is one in which policymakers discuss economic conditions, which we'll call FOMC 1. And the second round is when they discuss the appropriate policy response to those economic conditions. All right? So each round begins with a staff presentation of the green book in the FOMC1 and the blue book in the FOMC2, followed by each policymaker in sequence providing their views. So how are we going to measure risk perceptions and uncertainty perceptions from this data set? So I want to go to FOMC1. This is the part of the meeting where policymakers are discussing their views on the economy, and to the extent they perceive there to be risks in the inflation or growth distribution, we believe they will discuss them in that part of the meeting, all right? So for each speaker meeting observation, I'm going to take the FOMC1 text and feed it to a large language model to query the following object, all right? So for both inflation and growth separately, I want the text mapped into one of four categories: upside, balance, downside, and not discussed. All right, and so this BORITV is going to be this speaker meeting level observation specific to growth or inflation, which lies in one of four mutually exclusive categories. So there's always a bit of, I don't know what you'd call it, sort of kicking the car to get the LLM to work. The main problem here was understanding the difference between forecast disagreement and risk perceptions, all right? So it's not enough to say, I think the staff inflation forecast is too optimistic. I think inflation will be worse. That's not what we want to pick up, because that's just disagreement about the first moment of the distribution. We want a speaker's acknowledgement that their own forecast of inflation and growth has some risk in a particular direction, all right? So that's the main modification that we made to the original 98 prompts. All right, so we asked the LLM to give back to us the quotation that motivates the classification. And if you read through these, it's clear that this is not exotic language that the LLM is making a big leap to try to classify, all right? You get sentences like, the risks to the inflation outlook remain balanced. Okay, so fine, it's hopefully not controversial that one would classify that as a balanced risk assessment for inflation. I would also judge the risk to the inflation outlook as being biased to the downside, and so on and so on, all right? So a lot of these quotations are just very, very direct. Here's the, some quotations for growth. The risk to satisfactory economic performance will remain skewed very much to the downside. Okay, so we have been intentionally conservative here. So this insistence that you distinguish between first moment forecast disagreement and risk perceptions around your own forecast means that many of these speaker meeting observations are not classified. Right, so the top panel and the middle panel show the inflation risk share and growth risk share classified by year, and the gray bars are the not discussed share, all right? So this is by far the largest share, so it's not like every speaker is discussing risk perceptions in every meeting, right? Okay, so we can use these speaker level objects directly, and I will. But we also want to run meeting level regressions, okay? So how would we aggregate these individual risk views up? Well, a very simple idea is just to tabulate the number of speakers that expressed upside risks in a particular meeting, the number of speakers that expressed downside risks. Sometimes those two shares I will introduce separately in a regression. You can also difference them to sort of create a balance measure, right? So on balance, were more speakers talking about upside or downside risks. So here's the time series of that balance measure. Okay, I don't want to be too dramatic or self-serving, but there is an enormous literature on measuring uncertainty in economics. Right, the number of citations accruing to the Baker, Bloom, and Davis paper, I think, continues to be exponential. Okay. And Nick Bloom told me that one paper changed the QJ's impact factor by like 7 or something, okay? So we're all aware that one can generate time series of uncertainty, right? But this is different, okay? So the first reason it's different is because the existing uncertainty measures are really about public perceptions of uncertainty, to the extent we think the media is, aggregating some notion of public or market uncertainty. Okay, this is not that, right? This is policymakers' perceptions of uncertainty. Okay, the second thing I'll mention is most of these uncertainty metrics are rising in recession, so I guess countercyclical. Okay, if you look at the inflation risk measure, it's not. Okay, so it is a risk measure that actually rises during expansions and falls during recessions. All right, so these are sort of qualitatively different objects than what you might be familiar with. Okay, so it's usually not a good idea to present a paper as a history of ideas that failed and tried again or whatever. But in this case, I think there's value in it, all right? So even relative to the standards of academics, I think I'm very slow. So we started this paper, I think, in 2018, and we're still working on it in 2026. One of the reasons is we started, at that time, building dictionary measures, kind of inspired by this Baker, Bloom, and Davis style literature, right, where you basically measure uncertainty by tabulating words related to risk and uncertainty. Okay? It turns out that in aggregate, that sort of works as I'm about to show you. When you go to the speaker level, these get very noisy, all right? And so using the LLM has really helped kind of sharpen the measurement exercise. But given that they're present and we've built them, I think, there's a nice validation exercise that one can do, all right? So you've built this LLM measure of the balance of risk views in the FOMC. How does that relate to a more old-fashioned way of doing things? So one of these indices we build is called the PMU index for Policymakers Uncertainty. And that tabulates the number of risk and uncertainty terms in topically flagged sentences, all right? So pick all sentences that contain the word inflation and then count the number of uncertainty keywords. We also built sentiment indices. So in those same topically flagged sentences, basically tabulate upside versus downside language. So we have an uncertainty index and a kind of directional index. Okay, and we were trying to argue that captured the second and the first moments of the growth and inflation distributions. But you can see the value the LLM adds here. So these are just simple cross-sectional regressions of these balance of risks balance measures on these indices, all right? And both indices matter, all right? So when this dictionary measure of inflation uncertainty goes up, this balance of risks for inflation goes up too, all right? But it's also got some directional component. So when the inflation sentiment index goes up, which means inflation rising in the FOMCs, that's also positively correlated with this balance of risk measure. All right. So what we're measuring is really directional risk, I would say. All right. So it's not just generic uncertainty like a mean preserving spread of the inflation and growth distributions. It's really about a particular direction in which that risk is being perceived. Okay. And the R-squareds of these regressions, when you include everything, is fairly high, which I find reassuring. So the LLM is not picking up something crazy. I assume everyone in this room knows what the summary of economic projections is. So I won't explain to you the background of this. But in meetings where there is this survey that is conducted for building the SEP, policymakers have to answer this survey question as part of the exercise. Please indicate your judgment of the risk weighting around your projections with 3 responses: weighted to downside, broadly balanced, weighted to upside. Well, that looks a lot like what we tried to query the LLM on. Okay, so for SEP meetings, and just to remind you, there are 4 meetings per year where the survey is conducted starting from 2012. I can build this matrix. Okay, so SEP responses are tabulated on rows. LLM categorizations are tabulated on columns. You can see that so observation 1 is there are just very few upside growth risk classifications by any technology. All right, so when we talk about risk, it's really downside growth risk and upside and downside inflation risk. So when the SEP provides a clear direction, the LLM has very high agreement rates with it, right, 85, 90%. When when the SEP indicates balanced, the LLM is a little more liberal. All right. Now, when I first created this matrix, I was tempted to call it a confusion matrix, which in machine learning is the tabulation of true labels on the row with predicted labels on the columns. And then, for fun, I went to examine the disagreements between the LLM and the SEP. And then I stopped calling this a confusion matrix. Okay, so let's go to maybe the bottom. So this is Bullard in September 2016. So his SEP response was that he perceived there to be upside inflation risks. There's a verbatim quotation from FOMC1 of the same meeting. I do remain concerned that market-based measures of inflation expectations remain too low to be consistent with the 2% inflation forecast. This is a risk to the outlook that I have described. So I'm not quite sure what's going on here. You can also see, in these other cases, people seem to be directly contradicting themselves in FOMC1 relative to their own survey response, which was meant to have been done the day before the meeting. I don't have an explanation for this except to say validation, it can be more difficult than we think. Okay, so I guess it's nice that these things are related, in particular when the SEP gives a clear direction, but I would take this as suggestive that the LLM isn't crazy, rather than, there's a particular error rate attached to any of these classifications. Okay. All right, so let's get to the effect of these objects on policy. Okay? So this is the most standard Romer and Romer style policy regression we could think to run. All right, so we have the change in the interest rate at meeting T regressed on the lag of the interest rate. XT contains all the standard controls one would put in such a policy rule. So Green Book forecast for inflation and growth, revisions to those forecasts. I believe we also put a trend inflation measure in. Trying to be as standard as possible. And then into that, we put these balance of risks measures. Okay. All right, so columns 1, 2, and 3 actually don't include the Green Book controls. Okay, so they're just putting in our balance of risk measures alone. All right, so in this particular regression, we're separating out the share of upside and the share of downside classifications in the meeting rather than building this net balance measure, but I will return to the net balance measure momentarily. So what do we notice? Well, upside inflation risk and downside growth risk are really the ones that drive policy responses. Okay? And those policy responses, at least before we put Green Book controls in, are quite large. So this is in basis point terms. And I believe, you can see it in this graph here, the range of these variables isn't quite from 0 to 1, it's from 0 to 0.75. When I see the 0.283, if I look at the range of this variable, it's not quite going to generate a 28 basis point change from its minimum to its maximum, more like a 17, 18 basis point change, but that's still pretty big. Now, to go back to the model that I wrote down, you might think that some of this is coming from certainty equivalence, right? So balance of risks may just be proxying for expected economic conditions. And so when you put the Green Book controls in, which are the staff view of economic conditions, the first moment of economic conditions, you would expect those coefficients to fall to the extent they were capturing those first moment effects. And indeed, that's what we see, right? So those coefficients are cut in about half, but they're still pretty chunky, both in economic magnitude and statistical significance. Okay, I want to do the same regression, except at the speaker level. Okay, so we have a bunch of other regressions, but for the sake of time, I'm not gonna go into them. So in aggregate, we see that variation in this sort of net balance of risk measure matters. But you might argue that regression misses out certain things, right? So there may be unobserved macro shocks. There may be time trends, because we run that policy regression, essentially it's a cross-sectional regression, and there may be some trends in risk perceptions or the shadow short rate in the period we splice it in or whatnot. Okay. You might also think that balance of risks is a kind of hawkish fixed effect. Okay, it's just a way that a hawk says they're a hawk. So to solve both problems, we're going to run a panel regression model. So YIT is now going to be member I's policy preference at meeting T. I'm going to include speaker and time fixed effects, which should soak up variation that might be confounding the interpretation of the aggregate variable. And then I'm going to include 3 different categories for both inflation and growth. Okay, so upside, not discussed, and balance. So the coefficient estimates I'm about to show you are the speaker level impact of discussing or saying that you believe there's an upside rather than a downside risk to the particular outcome. So any of you who follow the FOMC will realize that there's not a whole lot of preference heterogeneity in the official voting record. Okay, so we can't use actual votes. One thing we can do is use a hand-coded data set that Ellen Mead built that covers the sample period 1989 to 1997. So she read the FOMC transcripts, realized that there's disagreement in voice, even though there's not disagreement in the voting record, and so she builds a data set of those speaker meeting level preferences. Okay. Because that's only available for certain years in our sample, we extend the observations using an LLM, but I think for the interest of time, I'm going to skip that. So this outcome variable is not an LLM variable, it's this hand-coded Mead object. And this is still a basis point interpretation, all right? So when we put in meeting and speaker fixed effects, the basis point shift in expressing upside versus downside risks falls, but the significance, at least for the inflation upside risk, is maintained. I think more impressive is this exercise. So the SEP is probably most famous for the dot plot. Okay, so what is the dot plot? Well, these are individual level statements of where the Fed funds rate should be at various future horizons. Okay, and some of y'all in this room may know about the SEP more than I do, but my interpretation of the dot plot is not a forecast, it's really a preference. Okay, so at least I guess it's unclear how policymakers are actually behaving, but the formulation of the question really is, where do you think the Fed funds rate should be? Right. So we're going to use these speaker level preferences from the SEP at the 1 and 2 year horizon. Okay, so most of the disagreement about the Fed funds rate shows up at these medium run horizons, not the very short run or very, very long run. Okay, so the nice thing about using this outcome is not just that we can include meeting and speaker fixed effects on a panel regression. It's that the SEP also has other survey questions about the growth and inflation distributions. So there is a question asking FOMC members to state their point estimates of these distributions at the 1 and 2 year horizons. So we can include first moment forecasts in addition to this balance and risk variable. There's also an SEP question about perceptions of raw uncertainty, so more like pure second moment around these forecast distributions, which we can also include. All right. So these are the results for the 1 and 2 year ahead Fed funds rate forecast at the SEP, where we don't include these SEP first and second moment forecasts. And again, the result that it's really this sort of upside inflation risk that survives the meeting and speaker fixed effects is apparent here, just like on the Mead data set. And when you include the SEP point forecast and SEP uncertainty controls, these effects go down a little bit, but they're not driven out. Okay? Now again, to talk about magnitudes, those are basis points. So after putting in meeting, speaker fixed effects, SEP first moments, SEP second moments, I still get almost a full, a full hike difference, 25 basis point difference, at how the FOMC should be behaving over the next year. Okay? To be honest, I was shocked that these regressions work out when you think about the number of controls that have been put in. Okay? But apparently there's a robust relationship between people's risk perceptions and their interest rate preferences. Okay, so if you're convinced of that, hopefully you'll have the patience to listen to me explain why that effect might materialize. So these have been policy rate regressions. Of course, one of the reasons these policy rate regressions are run in the first place is to strip out the residual from them and call it a monetary policy shock. Okay? And there is a nice connection between recent monetary policy shock constructions and this idea of certainty, equivalence, and balance of risks. So I assume most of you will be aware of the Romer and Romer shocks, which basically estimates that Fed funds rate policy rule, which I showed a few slides ago, and takes the residual. So there's this more recent work by Aroba and Dreschel, which says the following. Well, when you write down the policy rule, it's the expectation of inflation and the expectation of growth that enter. Green Book forecasts, which are the standard controls in these policy regressions, are modal. And so if you're facing an inflation output growth distribution which has some skew, that means the expectation of these distributions deviates from the mode, which means part of the monetary policy shock from the Romer and Romer regression is the failure to control for the expectation. Okay? And so what they do is they use text. I think they use beige book and green book, different color books, and argue that in stripping out the variation in the Fed funds rate that can be explained by beige book text, they're stripping out the impact of expectations on policy choices. Okay? If that's true, then we should find that our balance of risk measure explains Romer and Romer shocks, but does not explain the AD shocks, right? If AD have cleaned that effect. So here are the results when we regress our measures on the Romer and Romer and these AD shocks. Okay? So again, we find, like in the speaker level regressions, it's really the inflation side that matters when you control for enough and jointly put in growth and inflation. Okay, so both for the Romer and Romer shock and the AD shock, the balance of risks for inflation are what correlate with these objects. The sign, the magnitude of the effect on the AD shock is quite a bit less than the effect on these Romer and Romer shocks, which is consistent with part of the effect coming from certainty equivalence, but it's not fully driven out. Right? So there's some part of these AD shocks that's still correlating with balance of risk measures, even though these authors have explicitly stated in their paper that the shock should be cleaning of this effect. So what is our, what's our view on why this effect is arising? Well, there's a nice Blinder and Rice review article, I think it's in the Journal of Economic Perspectives, discussing Greenspan's tenure at the Fed, and discussing risk management. I think this was a period of time when robust control was a big deal, and people were trying to operationalize a little bit what risk management means. But they viewed insurance as explaining some of Greenspan's thinking. Right? So here's a couple of speeches, one by Mishkin, another by Bernanke, in which this insurance reasoning is explicitly stated that if the FOMC takes a large enough action, they can reduce the probability of adverse macro outcomes. All right, so it's not just about responding to adverse macro outcomes, it's about changing their distribution, right? Changing the likelihood of future outcomes. All right, so that's what we want to explore. So this is the measurement exercise that is the most difficult in the paper. So it hasn't, I haven't fully audited it and validated it. So the particular numbers I'm about to show you might change a little bit. But we're trying to measure which FOMC meetings were characterized by insurance reasoning in FOMC2. And we will use a large language model to categorize a meeting as having this style of reasoning or not. Okay. So I want there to be two different components of the reasoning of the FOMC to classify it as an insurance meeting. So the first is that an insurance motive is discussed. How do we describe that? Explicitly argue for taking action to hedge against uncertain future risks, even if not the most likely scenario. Right? Second, there needs to be some link between that argument and the policy choice taken. So it has to be part of some causal narrative inside the FOMC2 policy round, right? So because I feel this way, we should take this action today, right? So that's the idea. 46% of meetings have this insurance motive. To be honest, I'm currently redoing this. I think it makes more sense at the speaker level rather than the meeting level, all right? And then use the kind of speaker level distribution of these objects. But it's still interesting what we're able to say here. All right, so let's go back to the very simple policy rule from the framework and talk about AD shocks and insurance. All right, so let's think about FOMC meetings where insurance doesn't operate. All right, so this PT prime is 0, and that second term in the inflation part of the rule drops out. Well, the only thing left are expected economic conditions. Okay, so if the AD shock has cleaned the Romer and Romer shocks of the mean effect of the balance of risks, then when I don't have insurance reasoning, the AD shock should be near 0, right? Because they've sort of fully characterized what drives policy in those meetings. On the other hand, if there is insurance, then there's a wedge in this policy rule that the AD shocks would not have cleaned. So this is my favorite chart in the paper so far. The gray kernel density is the distribution of the AD shocks in this sample. I should say the AD shocks stop in about 2008, so this is 1982 to 2008. We've then binned FOMC meetings in different parts of this AD shock distribution and tabulated the share of meetings that have insurance reasoning. Okay? If you go to the middle of the distribution where the AD shock is 0, relatively few meetings mention insurance. And when you go into the tails, like where you have these really big shocks, especially the lower tail, the vast majority of meetings involve insurance. Okay? So that's already interesting. Okay? It doesn't yet speak to our balance of risk measure, right? Because this was meant to be a exercise about balance of risk. This is just saying that large shocks are associated with insurance. Okay, so let's go back again and think about this policy rule. So that argument was really about, I guess, the extensive margin. When you turn on insurance, you're going to generate shocks because there's going to be this, this wedge in the policy rule. But now let's say that insurance is turned on, okay? And I want to ask the question, once insurance is turned on, what does the balance of risks distribution do for policy? So one way of using this little rule to motivate that is to say the following. All right, this delta t squared object is the size of the adverse event that will be realized if you don't take action today. Okay? And one interpretation of our balance of risk measure is, the salience of the risk, which is plausibly related to this delta t squared. So it's not as straightforward as it might look because this is a nonlinear equation. But you can show that when delta goes up, you take more aggressive action. Okay? So to the extent that this delta is correlated with balance of risk measures, it should be in insurance meetings that variation and balance of risk is really driving the AD shock. Okay? Nobody has asked so far, so I'll ask for you. Why, when you write down this model, is there only an effect on inflation? Okay, that was just for expositional purposes, right? I don't believe that inflation risk is the only risk that operates. So if you feel like there's insurance for against downside growth events, there's just a similar term on the right hand side. Okay, so all the same arguments apply. All right, so let's return to this AD shock regression. And column 1 replicates what you've already seen. Column 2 and column 3 stick in this insurance reasoning indicator by itself, which we've already seen won't change the average value of AD because it induces this U-shape. The interesting thing is when you interact the insurance indicator with the balance of risk measures, you see that the entire effect, this is particularly clean for inflation, the entire effect of variation in this inflation risk measure on AD shocks is coming in insurance meetings. And that is exactly what you would predict under that policy rule. Okay? Now, one objection may be that the balance of risk distribution looks different in insurance meetings and non-insurance meetings, right? So it's only in insurance meetings that people talk about risk at all. Somewhat surprisingly, that's not true. All right, so the distribution of the balance of risk measure is almost indistinguishable in insurance versus non-insurance meetings. Okay, it just looks like in insurance meetings, balance of risk does something qualitatively different. Okay? Now, I don't work in the monetary policy shock literature, but my understanding is that they should be unpredictable. Okay, let me also guide your attention to the R squared in column 4. So the R squared is about 0.28. So once one thinks about insurance and balance of risk measures, these AD shocks are predictable. In particular, the large AD shocks are predictable. Okay. So, in conclusion, do policymakers respond to risk and uncertainty? Yes. Okay. That required 2 efforts. One was to build these measures in the first place, and the second is to develop all these policy outcome measures, both at the meeting and the speaker level. If so, why? I'm not saying certainty equivalence is not important. There's plenty of evidence in these slides to suggest it is. I'm just saying that there's another part of the story called insurance, which has been discussed by policymakers a long time, and now we have some academic evidence showing that it matters. All right? Everyone's been very polite, so I, in fact, have 3 more minutes. Let me say one more thing, if you'll indulge me. The one result, so I guess there are 2 additional results that might be worth discussing. The first is, as one of the discussants said yesterday, these meetings involve more than just today's policy rate. They also involve some signal of future policy rates through forward guidance or the drafting of FOMC statements. So there's also an impact of balance of risks on those, especially when no action is taken today. Okay, so there's some sense that if you don't feel like insurance is strong enough to motivate a move today, you can signal to the markets that you will be vigilant. And then the one thing missing from a macro talk is some kind of VAR local projection. Okay, so we have done that. I'm slightly uncomfortable with time series, strangely, but certainly in this crowd, I don't want to embarrass myself. But I can describe what happens. So once you put the inflation upside growth variable in a standard VAR, you can see that it does have expected macro effects. Okay, so CPI inflation is declining for 12 months after a rise in balance of risks inflation language in the FOMC. Unemployment rises a little bit and growth falls. All right, so it looks like the taking out of insurance due to risk has real macro effects. Okay, and again, I guess follow-on work would need to explore welfare and optimality, but the story would be it's worth paying this small output cost to insure yourself against disaster. Okay, so I think with that I will end. Thanks.
Great, Stephen. Thanks for being in time because you finished 2 minutes earlier. So for those of you who had questions during the presentation, please raise your hand and speak up. Let's collect 2-3 questions and Michele, let's go this way.
Do I not get an AI question?
No, not only papers presenters get AI questions, sorry. We can do it. Michele.
Yes, thanks. It was a great talk, thanks. So I have a comment and a question. So one comment is, I was wondering whether actually, because I noticed your result is that this balance of risk gives you a wedge from a standard monetary policy rule. And you know that there has been this debate that before the great financial crisis, the US monetary policy was too low for too long. And some people were actually mentioning that this was because of this risk management approach, maybe a little bit overdone by Greenspan. So one comment is that maybe you want to have a look at whether indeed these deviations were more, stronger in that period. Because I remember that there was a discussion in which Bernanke participated, and basically what he argued is that US monetary policy wasn't too low for too long. Actually, it was following literally a Taylor rule if you take into consideration that the rule would have inflation expectations rather than, forecast of inflation rather than inflation itself. But that wasn't very convincing. So I guess, maybe you have a very clear and clean account of that too low for too long. And my question instead is more like, you're using this balance of risk in these linear rules, but there is also another effect of uncertainty, that it may actually make the reaction to a current economic condition different, maybe more aggressive or less aggressive. So I was wondering whether you would also want to have a look at whether this uncertainty can actually interact with the coefficients on the reaction of the rules on current economic conditions.
ECB. Just 3 quick remarks. You made this distinction between FOMC 1 and FOMC 2 and that the opinions could change. But actually, the FOMC is on like Tuesday and Wednesday, and at least in the context of the SED, people submit their forecasts by the Friday before and typically do it 1 week before that. So there's a fair space of time for indeed real time and so on. The second thing is, I wonder, given historical transcripts, whether you could distinguish between board and regional presidents, because if there's dissent, it's typically from regional presidents. The final thing is, actually, I don't quite know the sample, but the interest rate was at the lower bound for since 2008 to 2021, because there was a huge amount of policy certainty. So I'm wondering, you get dramatic results, and yet policy was actually very stable over these particular periods. Thanks.
Can we stop after 3?
Okay, let's stop.
No, it's a good idea. One more, but then I'm going to forget.
Well, go ahead then. Let's go with 2. Go ahead.
Thanks. Yeah, so one of the things we wanted to start to explore when we first worked on this were these Brainard type stories, that risk and uncertainty enters through the reaction function in some way. And I think that there's some parameter uncertainty that governs the behavior of these policymakers, because you can read it in the transcripts, the sort of wait and see because of Brainard style uncertainty. But I think the time series variation in risk and uncertainty seems to be less related to time series variation and model parameter uncertainty. So, for example, there's almost no discussion in these transcripts of uncertainty about the coefficients in a rule that would map interest rate decisions into outcomes. It almost seems like it's taken as given. So I think one limitation of the policy rule is that it's static. If we were going to write down the full kind of dynamic path, I think that these parameter uncertainty issues always restrain immediate action. And in some sense, these balance of risk measures are about the debate, how fast should we move given those constraints? So I think the true model would have this interaction, that there's some motive to move slowly, but when risks start to accumulate, we need to speed up a little bit. But then, if we didn't have Brainard uncertainty, we could just adjust immediately. So that's kind of my interpretation. So in terms of the next questions, in the full sample where we run from 1982 to 2019, we splice in I think it's the Krippner shadow short rate. These conversations get a little technical for me, but there's a Wu-Jia shadow short rate. For some reason, we prefer this Krippner shadow short rate. But it's true that if you look at the R-squareds of the regressions, they go up quite a bit when you drop the shadow short rate. So I think it's kind of so when you drop the 2008 to 2015 meetings where the shadow short rate's being spliced in, and leave the Fed funds rate as the sample, I think the R-squared doubles. So there's something weird about the shadow short rate variation and its relationship to balance of risk. So this disagreement between the SEP and the transcripts I've used kind of interesting. My understanding is FOMC1 is to some extent pre-prepared, especially among the regional Fed presidents. I think they're basically reading out a briefing that their staff gave them. I know less about the institutional details of the SEP submissions. It might be interesting to speak afterwards about it. I guess the question is, whatever those are, seeing direct contradiction seems a little strange to me. I'm not sure if we should expect that or not. And then so I think we could do more with the composition of the Fed, this governor president. I'm not quite sure how it maps onto the insurance motives and things like that, but maybe we could speak afterwards. Thanks.
Let's go, Pablo, Max, and Alba. Quick, please.
Hello, Stefan. Thank you for the presentation. We learned a lot. Post 2008, another concern is financial stability. So that's a risk, especially in 2023 with the Silicon Valley Bank. So you're omitting that in your analysis. Do you think you are overstating the importance of the inflation and growth risks, and whether it's worth trying to have this third form of risk in your analysis? Thank you.
Alvaro.
It is something similar to what Michele said. It is about these non-linearities, but I think there is also asymmetry. Look that when the things get highly uncertainty, people react more to the downside risk of growth rather than the inflation. I wonder if you can introduce in your SVR future models of this kind of asymmetry between growth and inflation. So it looks that in this situation, the thing changed from a balance, inflation, and growth risk to more people who doesn't want to be remembered because it was generating a recession or something like that.
For the very fascinating presentation. I just wanted to look back to the strategy review, because there we actually do have an exercise where we construct a multivariate balance of risk from basically a multivariate at-risk model. And there's a counterfactual exercise that we do where we try to actually back out the optimal policy rate given constraints and also given certain counterfactual assumptions. And one interesting we see there is that kind of during a watershed moment in like 2022, right before the Russian invasion and these types of things, if you actually change assumptions for let's say energy prices, financial stress and so on, you do get a different rate path out. But given what policymakers knew at the time, you basically get the rate path that was actually implemented, which is fascinating. So I was just wondering whether you have also looked at watershed moments where basically your FMC might have changed, given that something had happened in between, and how the risk assessment might then have changed and kind of tilted just as an asset test maybe as well.
Sure.
Thanks.
Yeah, so there's a finance literature about this question, and I think one of my co-authors in it, she's like has contributed to it, that does the Fed react to financial conditions because it cares about financial conditions per se, or because financial conditions spill over into the real economy and generate a growth risk? And my understanding, at least in my co-author's paper, is that it's more the latter. So this economics of the Fed put is not about the Fed seeking to stabilize asset prices because they care about asset prices. It's because they want to, stabilize against the wealth effect, which might drive growth down. And so I didn't much have time to talk about it, but I think Jordi Galli has some work on this, that sort of financial stability concerns can be rationalized in a new Keynesian model insofar as they generate these adverse growth outcomes. So I guess what I'm trying to say is downside growth risks, I view them as encompassing financial stability concerns. And indeed, I think so, especially some of these 2008 insurance meetings and the two speeches I put by Michigan and whomever else, I think were really about this. There's one. So in these VARs, you can introduce inflation balance of risks and growth balance of risks separately, and they look very different. So the inflation balance of risks looks like the FOMC getting ahead of the curve. So actual inflation falls, unemployment rises a little bit, output falls. Growth risk look very different. So it looks like the Fed is more chasing its tail. So even though you respond by loosening to an increase in growth risks, you still see falls in output and rises in unemployment or whatever. So it looks like the insurance that's being taken out against inflation is real insurance. Or like in this sample, you don't see adverse outcomes. Whereas for growth risk, whatever insurance is being taken out only partially hedges the shock. Because to some extent, I guess the shock has been realized, and you're just trying to stabilize things from that point on. And I would love to talk more. So because there's some pretty long literature, going back to the Killian and Monganelli paper, growth at risk, inflation at risk, your poster yesterday. I'd really like to understand how to connect some of these measures to policy. Now that we see that it might matter. So I think there's more work to kind of integrate these two empirical literatures together. So if you have time later, maybe we can speak.
Thank you. I know we are over time, but let me ask this question. If you can tell us, I know it would take probably another lecture, so 50 minutes probably, but if you can tell us in 30 seconds, is traditional text mining, text analysis techniques, are they dead with
No, there's a great YouTube video about that posted 2 days ago.
Yeah, the one, the CPR. No, but if you can tell these folks, I know that it's a big question, but what is your take and what is the advice that you can give to our colleagues who work on this stuff?
I wasn't joking, by the way. So I don't know if you're on Twitter or LinkedIn, but I post like once a year because I'm not real into social media. But I posted a YouTube video of me answering this question.
Yes,
for about an hour.
It was advertised there.
Look, if I were to write down a statistical model of what we're trying to do when we do text analysis, it's that there's some latent variable, and we're trying to estimate that latent variable. And I think that there are better methods than AI for some of these latent variable estimation exercises. So if you watch that video, for canonical problems where human labeled data exists, it's difficult to find a setting where AI models outperform certainly fine-tuned small transformers like BERT and things like that. But sometimes old-fashioned bag-of-words models outperform modern AI models. So the idea that AI is more accurate at measurement, I just don't believe, and I don't know why that that belief is held by some. The measurement exercises we're doing here, they're a different class, I think. So whether insurance reasoning is present in FOMC meetings, that seems very difficult to create a ground truth label for. There's some other work, if I can have 5 seconds, that seeks to bias correct regression models where you introduce these AI indices. So I'm kind of also interested in that econometric problem. So in a world where you think there's large measurement error but no human validation data, which I'm sure is true of this work, you can keep using AI models because they're the only game in town for these difficult to measure concepts, but then think about downstream bias correction.
Great, thank you very much. Let's thank Stephen for this great lecture. Thanks a lot.